Hi, my name is Markus. Welcome to this video about the depth of market. In the previous video, I gave a brief introduction to futures trading. I hope you enjoyed it, and if you have never traded yourself before, learned a thing or two. However, I had to simplify things because obviously the target audience were absolute beginners without any prior trading experience. And of course, I didn't want to overwhelm anyone with too much information. But now that you know the basics, in this video, we can finally go a little deeper. And I think it's actually very important to do this because from my own experience, I know that many people, even though they have been trading for quite a while, often don't know how the markets really work. So in this video, I will explain exactly that. We will have a look at the so-called depth of market, and I will explain to you what really happens behind the scenes and what really drives prices up and down when you are trading. So let's get started. Let's begin with a quick recap. What moves the markets? Last time I told you that every trade always needs two sides, a buyer and a seller. So that means you cannot sell something if nobody wants to buy from you, and you cannot buy something if nobody wants to sell to you. Pretty obvious, right? Additionally, I told you that prices move because of supply and demand. Or in other words, if there are more buyers than sellers, so that means demand is greater than supply, prices go up. And on the other hand, if we have more sellers than buyers, so that means supply is greater than demand, prices go down. And this is obviously inaccurate because when you think about it, there cannot be more buyers than sellers or vice versa, right? Because in the beginning I told you for every buyer there is a seller, for every seller there is a buyer. So we have a one-to-one relationship here. Therefore, we need to be a little bit more accurate with that statement. And consequently, we need to dive a little bit deeper here so that we're able to do exactly that. So therefore, we're going to have a look at the so-called depth of market, or in short, the DOM. The depth of market is basically just a table with multiple columns, as you can see it here on the screenshot. The DOM is available in most popular trading platforms like Xerochart or NinjaTrader, for example. The DOM shows you in real time how many lots people want to buy or sell at each price level, and it also shows you how many lots have already actually been bought or sold at each price. And therefore, the DOM helps you to understand supply and demand in the current market situation, and it also can help you with your timing. So let's have a look at the typical columns of a DOM. The first column typically is the column that shows the price. It's also called the price scale or the price ladder. What you can see here is, of course, a fictional market with fictional prices. So don't be confused by the numbers that you see here. It's just an example. Every market has different prices, right? So this is just an example. But at every level, you have an individual price. And what you can see here is the last traded price in the middle, which is the price at which the most recent trade occurred. And then you see the best offer or best ask. This is what we see here in red. This is the lowest price a seller would accept. So that means when you want to buy or when you want to go long, you need a seller to sell to you. And this is the price that you can expect to get. This is the best price that you can achieve. And on the other hand, when you want to go short, you need a buyer, right? You need someone to buy from you. And here, the best bid shows the highest price a buyer would pay to you. So it's the best price that you can expect to get. And as you can see, there is typically a gap between the best offer and the best bid, and this gap is called the spread. The next column is the bid column. In the bid column, you can see how many lots people are willing to buy at each price. We can also call that passive demand, or to be more accurately, passive buy orders or resting buy limit orders. In this example, at a price of $49, you see that in total, people are willing to buy 21 lots at this price. For example, at $48, people are willing to buy in total 35 lots at that price. And at a price of $47, people are willing to buy 66 lots in total. So think of it like that. Instead of immediately entering the market and immediately executing a trade at the current price, you could also say, hey, I want to wait for a better price. So that means, for example, when you want to go long, you are waiting for the market to come down so that you can enter the trade at a more favorable price, at a lower price. And this is exactly what those people here are trying to do. They placed a so-called limit order down here at that price, which basically means that as soon as the market goes down and reaches one of those levels, these limits that are placed here, they are executed. And when they are executed, it is basically a buy order that is then executed at that price level. Then we have the ask column. The ask column, similarly to the bid column, it tells you how many lots people are willing to sell at each price. So consequently, we can call this passive supply, or again, more accurately, passive sell orders or resting sell limit orders. So just like in the example before, let's say here at a price of $51, in total, people are willing to sell 6 lots. And for example, at a price of $52, people are willing to sell a total number of 11 lots. And up here at $53, it's a total number of 29 lots. And the idea is exactly the same. Sellers are placing their orders here to be filled because, yeah, they want to get short, they want to sell the market, but they want to do so at a more favorable price. So that means they wait for the market to get a little bit higher so that they can sell at a higher price. The next column is typically the sold column. In the sold column, you see how many lots have actually already been actively sold at the bid at this price. So basically tells you how many people have pressed the button sell market at any given price level. We can therefore also call this aggressive supply, or more accurately, aggressive sell orders or executed sell market orders, because it basically shows you a history, a transaction history of all the previously executed sell market orders at every single price level. And then here in the bought column, you can see how many lots have been actively bought at the ask at this corresponding price. So therefore, we can call this aggressive demand. And again, more accurately, it's the aggressive buy orders. So the executed buy market orders at every single level. Okay, so let me illustrate that with a simple example. As you can see here, the last traded price is $50. The best bid is $49 and the best ask is $51. And then we just fill out those columns here with some hypothetical numbers. Of course, they will vary all the time. So whenever somebody places an order at a price level, the number goes up. If somebody cancels their order before the order is executed or filled, the number goes down. And now we have our trader, we have Bob, and Bob wants to sell one lot at the best price, so at the best bid, which is $49. And what happens is, because obviously you can see here, we have enough resting limit orders at this price level, so it's no problem to sell here, to sell into this passive demand. And this is exactly what Bob is doing. He sells one lot at the price of $49, and as you can see here, the resting buy limit orders, they are decreased by 1, so from 21 to 20, and here you can see 1 appears, showing that one lot has actively been sold into this price level. Then we also have Alice. Alice wants to trade a little bit bigger size, so she wants to sell 30 lots, also at the best available price of $49. But obviously, Alice has a little problem now, because as you can see down here, there is not enough passive demand to cover her aggressive supply, right? Not enough people want to actually buy at this level. As you can see here, we have only a total number of 20 lots, but she wants to sell 30. So not enough resting limit orders at this price level here. And this means aggressive supply is higher than passive demand. So consequently, she can sell a part of her position at that price level. So to be more precise, she can sell 20 lots here because there were 20 resting buy limit orders at that price, and all of them are filled now. So you see the resting buy limit orders, they are decreased to 0. There are no more orders waiting to be filled at that price level. And also the number here in the sold column, it increases from 1 to 21, indicating that another 20 lots have actually been sold at that price level. And now the best bid becomes $48. So the price goes down, right? Because there are no more resting orders here at that price level. So price has to go down to where more resting orders wait to be filled. Then the remaining 10 lots of her order can finally be sold at $48, which means that you can see it here, the resting buy limit orders, they decrease by 10 from 35 to 25. And here we can see the 10 informs us about the fact that 10 more lots have actively been sold at that price level. So as you can see, as I mentioned earlier, this column basically can be considered a history of the aggressive selling transactions, right? And when you sum this up, you see that 21 plus 10 equals 31. So in total, 31 lots have been sold at these price levels, which is exactly the one lot that Bob sold, and then additionally the 30 lots that Alice sold. So let's look at another example. Now let's look at an example where we have traders who want to buy rather than sell. Again, the last traded price is $50. Best bid 49 and best ask is 51. And Bob now, instead of like in the previous example wanting to sell, now he wants to buy. Let's say he wants to buy 2 lots at the best available price, so at the best offer, which is $51. So obviously no problem at all, because as you can see here, there is enough supply, right? There are enough resting limit orders at this level. So that means he can, without any issues, buy. He buys, right? He's a buyer. So he can buy 2 lots here at $51, and the number of resting sell limit orders decreases by 2 from 6 to 4. And now again, Alice, she wants to trade bigger size, so she wants to buy 41 lots at $51. And the problem here is the same that we had in previous example. So as you can see here, there is not enough supply, right? There are not enough resting limit orders to fill her market orders, right? Because she wants to buy 41, but only 4 are available. So the aggressive demand is higher than the passive supply. So what does it mean? It means she can buy 4 lots here at the price of $51. Resting limit orders are decreased to 0, so all have been filled. And those 4 lots that she bought, they are written down here. So 2 increased by 4 gives a total number of 6. And now the price has to rise, so the best offer becomes $52, right? Because all the limit orders down here have been exhausted, have been filled. But here is the next best price where we still have some limit orders waiting to be filled. And now we can buy an additional 11 lots at this price level. Right? It's still not enough to fill all of her orders, but at least another part of that. So additional 11 lots bought here at $52, which means the resting sell limit orders are decreased to 0, and we write down the 11 here in the board column. And then, since the resting limit orders are again exhausted at that price level, the best offer rises again. Best offer becomes $53. Then there is finally enough supply for the remaining lots to be filled. So that means the remaining 26 lots can then be bought at this price level here. Resting sell limit orders decreased by 26 to 3. And then we write down the 26 here in this column. And again, you can do simple math here, sum it up, and you will see that this shows you the history of the aggressive buying transactions, right? So in total, 43 lots have been bought, 2 by Bob and 41 by Alice. And as you have seen in the previous example, there are always two ways to enter the market. First way is to buy or sell at the next best price, so at the best bid or best offer, to immediately enter the market. This is exactly what you want to do when you say, hey, I want to get into the market right now for the current price, for the best price that is available. This is called a market order, which is an aggressive order. This makes you an aggressive market participant because you're actively doing something. You're actively executing a buy or a sell. This can, as you have seen in the example before, result in so-called slippage when there are not enough resting limit orders, right? Slippage means that there is a difference between the price you would expect and the price at which the trade is actually executed. And such a slippage happens each time there is not enough resting limit orders, and then the price has to move to the next price level where there are still more limit orders available to be filled. And this is exactly what happened to Alice in the previous example. Then the second option is to place an order at a specific price and then wait for the market to come to you. This can be a reasonable option when you say, I want to be in the market, but not at the current price. I want to wait for a better price. So that means if you want to buy the market, you place a so-called limit order or passive order below the current price. Then you wait for the market to go down and to fill your order so that you can enter with a better price, with a more favorable price. Or if you are a potential seller, if you want to go short, you're placing your limit order above the current price, hoping that the market goes up and then fills you at a better price level. This obviously avoids slippage, but there is the risk of not being filled, because if the market never moves to that price level where you placed your order, obviously the order is never executed and market simply moves without you in the opposite direction. And you have seen in this example that it's only the market orders, so only the aggressive market participants who ever move the price. So that means without aggressive market participants, without market order, nothing moves. If we have only limit orders, the limit orders are just sitting there at the price levels where they have been placed, and they are basically waiting there to be filled, and nothing happens until a market order comes and fills those limit orders that are waiting to be filled. So now, with that knowledge, we can finally accurately answer the question, what moves the market or what moves prices up and down? Initially, we said prices move because of supply and demand, and if we have more buyers than sellers, so more demand than supply, prices go up, and if we have more sellers than buyers, so more supply than demand, prices go down. Obviously, this was a little inaccurate, so now we can be more accurate with that statement. We can say prices rise when aggressive buy orders consume the available offers, which are the resting sell limit orders at the best ask. Or in other words, when aggressive demand is higher than passive supply. And on the other side, we can say prices fall, so the prices go down, when aggressive sell orders consume the available bids. Or in other words, the resting buy limit orders at the best bid. So that means when aggressive supply is higher than passive demand. Now, with the knowledge that you gained in this short video, you can now fully understand those more accurate statements down here. And as you have probably seen, the DOM can be a useful tool. It offers extensive information, but it is very difficult to monitor all of that information in real time. It's not that easy. I think it's very important to understand the DOM in order to understand what moves the market. So without having this understanding, it is very difficult to become a profitable trader. But the good news is you don't actually need to use the DOM in your daily trading, because there are some very good ways to project the most important information from the DOM directly onto your charts. So that means I personally, to be honest, I never look at the DOM. I don't have the DOM in my chart book. I don't care about it. I extract some of the information, print it directly on my chart. Not all of the information, only a small part, only a small fraction of the information that is really relevant for me and my trading. Because always remember, the more information you look at while trading, the slower you will be in your decision making. Right? So if you are looking at a dozen indicators and multiple different charts on various screens, it will inevitably slow you down. It will not make you a better trader. The opposite is true. You know the saying probably that less is more, and this is especially true in trading. In trading, less is more. And this is a mistake that many beginners make. So they want to have as much information as possible on their charts, and they are happy to add another indicator and another one and another one. And in the end, they clutter their chart with useless information that is not helpful. It's quite the opposite. It will harm their trading. It will not be beneficial for them. Right? So always remember, please, that in trading, less is more, and you do yourself a favor when you have clean charts. Use as few, let's say, indicators or tools as possible so that you can really focus on what matters the most. And I really hope that this short video was helpful for you, that you could learn a thing or two. If you have any questions, I would encourage you to join our trading community. You will find more information about that in the description and the comments below this video. As I already mentioned in the previous video, we have a very active, friendly, professional trading community. And yeah, we would be happy to see you there if you have any questions, if you're just looking for other professional traders to exchange ideas with or to discuss trading strategies or setups. You will definitely find nice, friendly people there. So looking forward to see you in our trading community, and thanks for watching. Take care. Bye bye.